I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a return guest. She wrote this very popular book. It's in its fourth printing. It's called Fed Up. She is the Federal Reserve expert, also a former top Federal Reserve official at the Dallas Fed. She was Richard Fisher's right-hand woman. I'm kind of giving it up. I got plenty to talk about. She's a writer with her brand new website called QuillIntelligence.com. It's Danielle DiMartino Booth. Danielle DiMartino Booth, thanks for joining us today on USAWatchdog.com.
It is great to be back, Greg.
Well, let's start with a trade deal. We had Mexico and Canada and NAFTA, which NAFTA no more, but we do have a deal with Mexico. What is Donald Trump's point? I've heard from my sources that China was cheating through NAFTA and dumping stuff in Canada and Mexico with shell companies. What's going on with this Mexico deal? Is it a big deal? Is it something good?
I think it's something that was necessary, Greg. Look, I live in the state of Texas, and we are the largest exporting state in the country if you take into account what occurs along our borders and the massive amounts of energy that comes through our ports in the Gulf. So it was critical to not just the nation's economy, but especially the economy of Texas, to keep those rail lines open, to keep those borders open, and to keep the trade that has really helped bolster the growth of the country up and running. If Donald Trump made some salient points to the people of China about, we're not going to take any kind of corporate espionage sitting down, then so be it. All the better as we head into this next round of negotiations, because truly it is the negotiations with China that matter the most.
And they were using NAFTA to kind of mess us over, right? I mean, they still have Canada open, but that pathway is going to be closed, correct?
They do, and I think the world is coming around, and this was probably one of the goals that the administration set out to. I think the world is coming around to the view that China stomping all over everybody's intellectual property is not going to be accepted on a global basis, and I think that part of the aim, and I hope that this works out for our country, that part of the aim was to raise awareness, not just in our country and among our electorate, but to raise awareness around the world that China should not be able to behave badly with American firms and with firms in other countries. And I like to think that our cache of allies has grown as a result of this, and that our standing in the World Trade Organization has improved, Greg.
Well, I want to move on after that to some of the stuff you wrote. You wrote a couple of great articles. You sent it to me, and it's Embracing the Unexpected, and then also this one here. I think it's The Key of XX. Is that right? The Key? Okay.
The Key of FX, yes. The perils of currency wars, yes.
Yes, and I wanted to read something that you put in here. I was on page 6. I read it all. It's very clever, very well done. I can see why you're doing this on QuillIntelligence.com. What's at risk is simply epic, and that's only if you peer into a lens that's confined to China. There is the rest of the world. Most of it is also straining under the weight of record leverage. The reason most pundits play down the subject of debt is so few can conceive a workable solution. Not even the world's best engineers can stop a runaway train, so you say in this latest article that you put out. The debt problem, everybody's pretending we don't have it, right? I mean, how long
it's so much easier to look the other way, because what exactly do you do with $250 trillion? These are numbers that few can even begin to fathom, much less come up with any ideas as to how to tackle the problem. And a lot of the debt is debt that is in the shadows that we can't see. That $250 trillion I just mentioned, that is what is visible and what is counted. That is not necessarily, again, what is off balance sheet, whether you're a country or a company.
And when you say not counted, you mean the problem's worse? How much worse do you think the problem is?
Look, I'm going to throw myself in the same boat as those who are not smart enough to be able to tell you. I have no idea. The IMF and the Bank of International Settlement recently came out with a report that said that we know of $11.5 trillion of dollar-denominated debt off our shores, and those are obviously problematic dollar-denominated bonds, as we've seen in Argentina, as we've seen in Turkey. But they went further to estimate that an additional $11.5 trillion was in the shadow banking systems in these countries, and that could come back to haunt us. Let me put that in quick perspective. Onshore, we've got $50 trillion or so in U.S. dollar denominated debt, as in domestically. So that's a lot of potential tender, if you will, if the dollar strengthens too much. And that is also why, if for any of you people who watch the financial markets, every time the benchmark 10-year Treasury approaches the 3% mark, which is a psychological level in theory, some country blows up.
Well, coming back to another thing that you wrote, I want to bring this in too. This is just something else that you wrote. I just picked this stuff out because I wanted to get this in. You're predicting that the dollar will strengthen, exacerbating, and then embracing the unexpected. The dollar will strengthen, exacerbating the dollar shortage. No, this cannot go on indefinitely. At some point, real economic activity will be encroached upon, and our nonchalance rudely shaken. What does that mean? How is our nonchalance going to be rudely shaken?
Look, Jay Powell is the first non-PhD in economics to be leading the Federal Reserve. In his past life, he worked in the industrial sector. So he still speaks to hundreds of CEOs constantly, and he is aware that regardless of what potentially our broken inflation metrics may or may not advertise about rising prices in this country, because he speaks to companies, because he listens to small businesses as well, he realizes that rising inflation, rising input costs, what it costs to hire a new employee really has grown appreciably, and that means more interest rate hikes than I think the market is anticipating. The more we raise rates, the stronger the dollar gets, the greater the risk grows for the rest of the world as well as our economy, Greg.
Let's talk about Jerome Powell. You know him pretty well. And I've had this running back and forth with Manarino and I. 1 minute we think Turkey's going to just fall through the floor. The next minute we get a trade deal with Mexico. We get all-time highs. The next minute China calls off trade talks. We got this seesaw of anyway, some people think that if Powell raises rates a quarter of a point, he's going to push some of these emerging market countries over and start a daisy chain effect. We're 6 weeks by the time they meet in a couple of weeks here. We're going to be 6 weeks away from a major election, less than that. 60 days. I'm thinking he's not going to raise because it's the political. Trump's going to be pissed. He could cause the economy to teeter. Is he worried about these emerging markets going under I know it seems kind of bizarre, a quarter-point rate hike, but is he worried about pushing the emerging markets under and strengthening the dollar even more?
Greg, William McChesney Martin was the greatest Federal Reserve chair in its 104-year history, and he had a good habit of giving the presidents under whom he served the Heisman. I suspect Jay Powell's going to do the same exact thing. He is the most independent Fed chair that we have had in over 30 years, and I think that he's going to raise interest rates regardless of what is happening in politics. He went off to Jackson Hole, gave a seminal speech recently, and he did not even make mention of politics and or the president strong-arming him. That is the kind of person who he is. He is independent. He is independently wealthy, and he has absolutely no reason to be running the Federal Reserve unless he simply wants to serve his country. And serving your country means that you don't kowtow to political pressure when you need to do right by the economy.
And what's doing right is does he think the inflation numbers are real? That are worse than what they're saying and what they're 2.9%.
Thank you. He thinks that the inflation numbers are underreported. He's listening to companies say that their margins, that their profit margins are being squeezed, that their non-labor costs, those are the costs that companies cannot control. Non-labor costs are outpacing labor costs by the greatest extent in over 3 years. And what that tells you is that inflation has run amok. The threats, though, and where Jay Powell needs to be very careful is after the September rate hike, after September the 26th comes and goes, then what's next? What's going to happen going into the fourth quarter, to say nothing of 2019, when every single Federal Open Market Committee is now live, because he's announced a few months ago that there will be press conferences following every meeting. Thank you, Jay Powell, for stopping the practice of wasting taxpayers' money by having 4 FOMC meetings per year be lame duck.
Are you worried about him raising rates and causing Turkey or Brazil or Argentina or any of the other countries that's in deep doo doo? I mean, you named in all your on your papers. I mean,
Yep.
you named them all. Are you worried? Are you worried about them pushing them over? I mean, causing the dollar to skyrocket? You think the dollar is going to start here? You think the dollar is going to strengthen and the Fed is going to raise rates?
I think that the Fed is going to continue to raise rates. I would push back a little bit in that the financial markets have fully priced in 90% priced in the September the 26th rate hike. And what that means is that the recent weakness that we've seen in the dollar may be looking forward to Jay Powell backing off come December. So I'm not really worried right now about a skyrocketing dollar because in my mind, at least, the way the financial markets work, the September the 26th rate hike is fully priced in. What happens next? We will see.
Why wouldn't he flip that and say, okay, you know what? It's just before a big election. I'm going to flip it and I'm going to say, we're going to pause right here, but we're going to have a rate hike for the end of the year. Why would
Nope.
he do that?
Not his style. He's
You don't
not
think he'll-
political. I will pound the table. As Jay Powell is not a political Fed chair, and amen and hallelujah to that. We've just come through 30 years of Fed chairs who were very politically malleable and would do by the president's bidding. I mean, there was nothing ever written in concrete about it, but it was certainly the case.
Do you think, and I'm not going to come back to me, do you think that they can crash the global economy and start a daisy chain by raising rates? And they're so weak right now that they could crash Turkey or Argentina or Brazil or somebody with a quarter of a point rate hike? Do you think they could crash emerging market countries with a quarter of a point rate hike?
No, I don't. Not one quarter of a point rate hike that the entire world knows is coming. But again, it's what happens after that because we do not know how some of these over-indebted countries will react if interest rates start ticking up. But at last check, long-term interest rates here in the United States were ticking down, and that advertises that there's a slowdown in the making, even though short-term interest rates are rising.
There's last time we talked on the phone, you were like, "Oh, hey, it's 25 basis points between the 2-year and the 10-year." I know other people look at the 10-year
Yep.
and the 30-year. That's 15 basis points. We have 35 basis points, and I'm not a scholar like you. I'm not an expert, but
Yep.
wow, 35 2-year money. Oh, that well, hey, if you just tie your money up for another 28 years, you can get 35 more basis points. How's that sound to you?
Why bother? Why bother? Listen, the difference between the 2 and the 10-year is around 20 basis points right now. It's flattened further. Last I checked, at least last I checked in my personal banking account, which is all in 90-day Treasury paper, I'm getting north of 2% paid for that every 90 days. And by the way, it'll be 2.25% after September the 26th. So for the first time in generations, it's actually paid to hold on to cash. And why not get paid? Why take why take the risk of going 28 further years out when you can get 2% today?
I mean, doesn't that signal a flattening yield curve? I mean, the 2-year is the
Yep.
30-year is 0.35, a third of a interest.
Yep.
1%, a third of 1% higher for 28 more years. I mean,
Yeah, and
isn't
we
that
just
signaling? Isn't the flat yield curve signaling a warning to the economy?
Absolutely. It always has. And in the past, when we've had stocks as overvalued as they've been in the instance of 1999, after the point of inversion, we were inside recession within 13 months. That's not a very long runway at all. So there's a lot of room for error to be made. The yield curve being as flat as it is definitely suggesting that after the third quarter that we might be in for rough going. In fact, that's what I'm going to be writing about next week for the first piece that I publish after Labor Day. And that's that we're seeing a tremendous inventory rebuilding process right now. A lot of that has to do with fiscal stimulus. A lot of that has to do with firms finally recovering after 2017, the year of the natural disaster. But absent further fiscal stimulus, I ask you the question, I put the question to you, absent further fiscal stimulus, what on earth is going to keep this economy chugging along after those inventories are replenished? What happens going into the fourth quarter? That's where my concerns are right now.
The rest of the world isn't doing it very well either, and I hate to bring this up. But I mean, Iran is having terrible problems with inflation. And other countries, as you know, you've just written about this in these two
Of
articles,
course.
having terrible problems with inflation, their currency problems. And it usually doesn't mean you have a strong currency. It usually means that people are, spending way more money, for milk and gas and whatever. What happens if Iran closes the Strait of Hormuz? I mean, they've been rumbling about. They say they control the strait. The White House says that's an international waterway. The Iran says you don't need to have your ships in the Persian Gulf. I mean, more nasty talk, but what happens if we have a big old fat war somewhere?
Not to mix metaphors, but that's truly the nuclear option, and I don't know that Iran would actually do that to itself. I think that the social unrest in Iran is getting us close, potentially close to the point where we see a revolution in that country that benefits those inside Iran. I think that if they were to do something as desperate as to try and close the Strait of Hormuz, that the ramifications for countries like India, any oil importing nation, would be devastating. And I don't know that the United States could do anything about it. I think that the international backlash would be tremendous.
Do you think that the dollar is, so you don't think the dollar is going to go up from here?
No, I don't think that the dollar is going to skyrocket from here, because I think that what we've seen more recently is, with the trade tensions easing, albeit forget the 800-pound gorilla of China, but with trade tensions easing, first with Europe, now with Mexico, presumably next with Canada, we've seen an easing off of some of the strengthening that we had seen in the dollar. So because by definition, if there are fewer tariffs out there, there's less inflation building in the pipeline and less reason for the Federal Reserve to be aggressive after September and continuing to raise interest rates.
Do you think the raising interest rates could cost Donald Trump the midterm elections? Or excuse me, it's not Donald Trump, he's not up for election, but the Republicans, the House? I know they're not going to get the Senate, but do you think they could cost them the House?
I don't think that a rate hike is going to be relevant in the midterm elections. I think that what's going to be much more actually relevant, and I'm not a political person in any way, shape, or form, but some of the most recent data that we've seen coming out shows that the third quarter growth rate is going to be as exceptional as that of the second quarter. And that would actually work to the GOP's benefit if the economy kept chugging along through the end of the third quarter into these elections.
You think Donald Trump can pull another rabbit out of his hat in terms of getting something, another deal with China? I mean, China can't afford a trade war either. They're acting like they can, but they really can't, can they? I mean, they've got a lot of debt.
China is in a much weaker position than the United States when it comes to withstanding the ravages of a trade war. Remember, they are an exporting monster, and it's not so much what they export directly to this country. It's, for example, that Hong Kong re-exports 58% of what lands on its shores from mainland China. They are a critical hub in the global supply chain, and the last thing that China can afford right now is for their exporting manufacturing sector to take a body blow. So they may talk tough. I was distressed to see that the trade talks collapsed, and obviously we've got a September the 6th next deadline coming up. I don't think any of us want to see those $200 billion in additional tariffs implemented, especially China.
I'm going to come back around to where we started, because I want to get your because this is the big elephant in the room, and that is the rest of the world also straining under the weight of record leverage. The reason most pundits play this down, play down the subject of it is so few can conceive a workable solution. This can't go on forever. Does this keep you up at night?
It really does keep me up at night because of the nature of debt. If there's one thing as we approach the 10-year anniversary of Lehman Brothers, if there's one takeaway that I think so many have forgotten in the decade that has since passed, it's that you don't know where the true ticking time bomb is when there's an over-indebted problem. You don't know if systemic risk, which is risk that once it's released cannot be contained by any higher authority, we don't know where systemic risk can potentially be unleashed. So I think that is the greatest perils of debt, is that we don't know where the danger truly lies until something triggers it.
You said on a past interview, and I was stunned when you said this, and I want you to go ahead and. Well, I was stunned. I was stunned when you said the Fed really doesn't know how this is going to work out. What?
No,
Uh,
no,
and
of course
so,
they
would you
don't.
please? You've talked to your friends about this. Certainly, they must have said, "Yeah, you shouldn't have said that about the. We don't know what's going to happen." But
Let me think. Do I have very many friends at the Federal Reserve? Gee, Greg,
did
was
you
that?
get grief for that? And what's your view on that now? Did you get grief for
I,
saying that?
I'll tell you what. Let me paraphrase Jay Powell, circa June 2012. October 2012. These are the first words we have of his on public record. Jay Powell was being faced with, as being a rookie, he started at the Fed in June 2012. As a rookie, he was being faced with voting on the final round of quantitative easing. And he expressed deep reservations because he said that when the time comes to begin to back out of this position, to unwind this massive balance sheet that we're contemplating building up, none of us can say what it's going to look like and where the risks will lie. Yes, it's true. I'm parroting Jay Powell, even though I said it before he did, because the transcripts, or at least I thought I did, because the transcripts are released with a 5-year lag. So we didn't know he said that until January of this year when they were released. But he was concerned 6 years ago that nobody would be able to determine how the unwind, how the exit from this massive $4.5 trillion domestic money printing operation. It is now over $22 trillion globally, if you add up what all the major central banks have done in terms of quantitative easing. He was the first one to say, in all humility, that he did not know how this was going to turn out. Neither do I.
When he's looking at the monetary policy and raising rates in September, I'll give you that. I hope he doesn't, but he may. I don't know. I'm going to go with you.
Again, if there's one
thing,
thing,
it's a lock. He's going to raise rates in September. Period.
He has been very much the sober adult at the table. He is not in the practice of surprising the financial markets, shocking them, if you will. I mean, trust me when I say the tinfoil wearing hat people on my Twitter feed would love the Fed to shock the markets. But again, the entire discussion that we've just had suggests that a shock to the system could produce some kind of a ripple effect that could not be contained. So if he knows that markets have priced in to the tune of 90% a rate hike on September the 26th, the last thing he's going to do is introduce a shock if he doesn't know what the ramifications could be in God knows what country.
So it's a lock. You could go to the bank. It's a quarter of a point. They'll raise it.
Absolutely.
Okay. What is his fear? What do you think could go wrong? I mean, what could go wrong with this kind of debt? I mean, I know Donald Trump knew about the 20 trillion when he walked into office, but I don't think he knew about the 21 trillion that Dr. Mark Skidmore came up with. And I'm bringing this up because it's a big number. A 21 trillion at the DOD and DOJ, and we can pretend that doesn't exist, but it does, according to PhD expert economist Dr. Mark Skidmore and a team of PhD level students at Michigan State University. It does, and they took away all the data that he compiled that with, and now it's a national security issue. We printed an additional $21 trillion. What's up? Why isn't the world grasping this? Why aren't the people that you talk to at CNBC? Surely they know there's an additional 21 trillion. Are they just going to pretend that isn't out there? Is the rest of the world going to pretend that's not there? Don't mean to get down on you because I know you're not.
No, actually, you're speaking out of my wheelhouse. But you asked me originally what would worry Jay Powell. Jay Powell comes from the world of private equity. And when Dodd-Frank was implemented, which I put right up there with the most boneheaded legislation to ever come out of Congress, when Dodd-Frank was implemented, what Wall Street did was say, you know what, well, now that they're going to regulate this corner of investment banking that used to be the most lucrative, we'll just move all of our really profitable, fat, lucrative business outside of traditional, conventional investment banks that are now overly regulated. We'll just move that into the shadow banking system, into the private equity world. What Jay Powell is aware of is the fact that there are trillions and trillions of dollars of leverage in this country that are not regulated by any entity and that could cause problems in and of themselves. But again, do you remember, can I rattle your memory with Angelo Mozillo and Countrywide? Again, a big company that was not regulated, and look at the problems that a lot of these subprime unregulated lenders caused way back when. If you want the parallel today, look at private equity and the trillions of dollars that they control of our financial system, where basically nobody's looking over them. The fox has taken over the henhouse, Greg. That's what keeps Jay Powell up at night. That's what keeps me up at night.
Do the people that you sit on the set with at CNBC, they realize there's this extra 21 trillion floating around out? That's a minimum. Do they realize that?
We never had that discussion, so I couldn't even begin to comment to it.
Do you think people in Washington realize there's an extra 21 trillion floating around out there? I mean, big money must know this.
You're asking me if Congress is in touch with reality.
Or
I'm thinking that's what you're asking me.
Or any of the big money players.
I'm no expert in the exact dollar figures, and I don't have the backstory on what you're talking about. But what I can tell you is that if it's bad news and you're a politician, then you can professionally ignore it and pretend like it's not there. And certainly, if you're in the media, that's the case.
Do you think big money knows that there's this extra leverage, whether it's this 21 trillion or whatever? Do you think big money?
I think big money knows exactly where the leverage lies in the financial system. If that's what you're asking me about, that I can speak to as an expert. And I think that there is a lot of concern, especially about the billions and billions of dollars that public pension funds in this country have thrown into a lot of these shadowy, in the shadows, levered up funds. But I tell you what, I understand it. I know what's going on. I don't think that the average pensioner knows that their pension future retiree payments are being taken to Vegas.
I don't mean to laugh, but
it's true though. I don't. Again, these are problems that we're going to find out about with Illinois and the city of Chicago and California and Rhode Island, Connecticut, you name it. These are going to be big problems in the coming years, Greg, and they actually speak to the social fabric of our country. And too few people talk about this, especially in the media.
Do you think that this is a reason why some of the big players, and I'm talking about my other contacts that do gold for rich people, and big money is putting a lot of money into gold? Are you hearing that?
Well, gold, Greg, I'm no gold bug, but what I can tell you is that gold is the ultimate hiding place. It is the ultimate place to hide when financial markets are disrupted, because when financial markets are disrupted, they tend to behave in tandem. In other words, all of that hooey about having a diversified portfolio and planning for the long term, all of that falls apart when there's disruption in financial markets, with one exception, and that would be precious metals.
Do you think it's worse now than it was in 2008?
I think that there's more leverage than there was in 2008. So if you're gauging it based on the fact that we used to have 160, 170, and now we have $250 trillion of debt, yes, Greg, things are worse. Things are definitely worse.
What's the one? I know you don't know where the arrows are going to come from, or where the ticking time bombs are. To your point, give me a list of the 2 or 3 things that you think could blow everything up. Is it one of these emerging market countries? Is it Italy? Is it Deutsche Bank? Tell me what.
Well, you've just named off. I mean, think about how interconnected Deutsche Bank is to the global financial system. Think about the European Central Bank and the fact that Europe still has negative interest rates, that they could go into recession with negative interest rates, what the implications would be for that financial system. Think about Italy, because I write about the subject a lot. And the public polls have not wavered since their elections there. The public is still very much in favor of this government that has always been opposed to being in the euro. If the single currency was to unravel, Greg, I couldn't tell you what the ramifications would be, but it would not be pretty if the European Union still had negative interest rates. The capital losses that would be sustained are you can't even quantify them, to say nothing of the Italian banking system that's a ticking time bomb. And then I mentioned our public pension system as well. And if you consider what American investors, what mom and pop retailers have been piling their money into, searching for yield, leveraged loans, high yield debt, go-go securities that baby boomers have no business being in, to say nothing of what happens if there's a fallout from the financial markets, given the fact that an entire generation of Americans, baby boomers, will only have their homes to fall back on. What happens then? Because we've got an entire generation of millennial home buyers who've had to wait 10 years to settle down. So again, the tentacles of over indebtedness, I could go on for hours talking about, but the potential catalysts are so numerous, Greg, that it's a wonder at all that I sleep at night at all.
Yeah, I guess for simple home players here, the home gamers, you just get out of debt. Would that be a simple, just get as much out of debt as you can? Is that what you're saying?
Well, I will say that's what gives me my peace of mind. That's the good side of it, is that I have no debt. So that's why I do sleep at night.
And you would tell people that if you want to do one thing, go hold your car title, hold your house title, get rid of your credit card debt. I mean, I'm getting down here to the granular little people level, but I'm one of those people. But you would just say, just keep a low profile, stay out of debt.
Look, again, we're in an environment where cash pays. There's absolutely no reason to take risk when markets are as overvalued as they are, when the rally's been going on for as long as it has. We're in the longest bull market rally in U.S. history. If people don't see that as a sign that maybe they should take some chips off the table, well, then I would refer them to my mantra, and that's that pigs get fat and hogs get slaughtered. Again, there's something to be said for the peace of mind of being out of debt, and the fact that you can actually get money on your cash investments. There's no shame in it. There is return in it, though.
And the last question, I just want to hit this because I'm sure Mandarino, so you should ask her more about that. The flat yield curve, I mean, between the 2-year Treasury, the interest rate paid on it, and the 30-year Treasury, there's a whopping 0.35 basis points, just 35 basis points, a third of a percent interest between the locking your money up for 2 years and locking your money up for 30 years. That's pretty much a flat yield curve. Is that signaling big trouble in the markets?
It is signaling that we have a slowing recovery in the offing, and that's what we've been talking about. Again, we might have a blowout third quarter. What the data suggests would be that we're going to have back-to-back very strong quarters of economic growth. But I ask again, is there another massive fiscal stimulus that's in the pipeline that is going to come to the rescue of this economy, or are we going to continue seeing what we've seen, which is nascent signs of slowing the automobile industry, definite signs of slowing in residential real estate? These are two sectors that we know from birth. The minute we get to business school, we were taught the two sectors that lead economies into and out of recession are autos and housing, and we've already seen definitive signs and evidence that both of these sectors are already slowing. So consider yourself to be forewarned.
You have a new website, QuillIntelligence.com. I'm going to link to it.
I do.
Okay, in the after the interview section. So you've got kind of a new little venture here. Tell me what's going on with QuillIntelligence.com.
Well, in the aftermath of Fed Up, there was quite the outpouring of, gee, Danielle, we would like to read you more. My weekly newsletter was very institutionally priced. It was a little high priced for the average mom and pop investor, retail investor to be able to read. So right after Memorial Day, I launched the Daily Feather at QuillIntelligence.com. It's $25 a month, and the subscription levels have gone haywire, and I am continuing on my mission to make the entire country financially literate by opening the doors to my unbiased, agenda-free research every single trading day of the year.
I will tell you that what you sent me a couple of these things. You sent the Embracing the Unexpected and the other one, and it's very, very cleverly written, very straightforward. It's kind of like your book, which is Fed Up, which is in the 4th reprinting. You can get all this. This is on QuillIntelligence.com if you want to get a copy of the book, which it's a big book. It's a lot of resources. It's very nicely done.
But it's very well written. It's quick. It's a quick read. You can attest to that.
And it's a very nice book. And QuillIntelligence.com is your new website. I will be linking to it. Danielle DiMartino Booth, thanks for coming on. I'm glad you came on so we could actually hear you talk. When I hear you on CNBC, and I'm not trying to dog them out, but you don't have to either. But they don't let you talk.
It is quick. They're sound bites. They're not called sound bites for no reason. But I do appreciate